Disclaimer.
While you were watching the paper price on COMEX, the physical silver market just hit a brick wall. Right now, the Dubai Air Bridge, the heart of global bullion flow, is paralyzed. 20% of the world's metal is effectively grounded, creating a physical vacuum that Western banks cannot fill. Asia saw this coming. They've spent the last 48 hours emptying the vaults, while the $100 dollar index acted as a smokescreen for your eyes. Today, I'm connecting the dots the mainstream media ignores. Why your physical stack is now at risk, how the Dubai supply crunch is triggering a COMEX default warning, and why this weekend might be your last chance to secure metal before the Monday gap. Let's get into the data. And it starts with a question that sounds simple, but almost nobody can answer correctly. When you buy a silver coin, a gold bar, or even shares in a precious metals ETF, where does that metal actually come from before it reaches an American vault or a dealer's shelf? Most people picture a mine somewhere in Nevada or Peru, maybe a refinery, maybe a straight shot to New York. But the real answer is stranger, and right now, a lot more dangerous than almost anyone is talking about. The real answer is a single airport in the Middle East. And as of this week, that airport is effectively dark. Let me back up and explain why this matters to you personally. Whether you own physical metal, hold a paper ETF, or are simply watching gold and silver prices, wondering if now is the moment to act. Because what just happened in Dubai is not a regional story. It is a direct hit to the physical supply chain that feeds American investors, American dealers, and the exchange that underlies nearly every precious metals trade our country makes. Dubai, specifically Dubai International Airport, quietly handles roughly 20% of all global gold and silver flows. Think about that number for a second. 1 out of every 5 ounces of metal that moves around this planet passes through a single hub in the Persian Gulf. It sounds like a fragile design, and that's because it is. Dubai evolved into this role over decades because of its geography, its tax-free trade zones, its world-class cold storage and vault infrastructure, and its position at the crossroads between Asian refiners, African miners, European banks, and American buyers. The system worked beautifully, right up until it didn't. On March 1st, 2026, Iranian missile strikes targeting commercial shipping infrastructure in the Gulf grounded all cargo flights out of Dubai indefinitely. Not temporarily, not with a workaround in place, indefinitely. And the traders who work this market every single day were not quiet about what happened next. On the record, they described Monday morning as scrambling with nowhere obvious to reroute to. That phrase should stop you cold. These are professionals whose entire job is knowing every alternative, every workaround, every backup corridor in the global metals trade, and they had nowhere obvious to go. Why? Because overland transport of bullion, trucks carrying gold and silver across borders, is considered too operationally risky to attempt at scale. You can't just redirect a cargo jet's worth of silver onto a convoy of armored trucks winding through multiple international borders. The insurance doesn't exist. The security infrastructure doesn't scale. The math simply doesn't work. So when the air bridge closes, the supply doesn't reroute. It freezes. Now here's where you need to pay close attention, because this is the part that catches most retail investors completely off guard. If you pulled up the COMEX silver price right now, you'd see something that looks almost calm. At around $83 an ounce, the screen price isn't screaming. There's no panic on the ticker. And that's exactly the trap. Because the paper price, the price you see quoted on financial apps and news sites, is a lagging indicator. It reflects contracts and futures and agreements made weeks or months ago. What it does not yet reflect is the physical reality on the ground, which is already decoupling from the screen price in real time. Here's a concrete example that should make this click. India is one of the world's largest consumers of physical gold, and their domestic market is extraordinarily sensitive to global supply disruptions. For years, Indian gold traded at a modest discount to London prices, sometimes $50 per ounce below international spot, because supply flowed freely through the Dubai corridor. Within 48 hours of the Dubai shutdown, the $50 discount flipped to full London parity. The physical premium moved $50 in 2 days, not because London prices collapsed, because physical supply arriving in India suddenly became scarce and buyers had to pay whatever it took to secure metal. Silver, according to traders closely watching these flows, is next in line for the same reckoning. And silver's supply chain through Dubai is actually described as more paralyzed than gold's right now. Pop quiz. Do you know the difference between the price you see on your screen and the price a dealer would actually charge you for a 1-ounce silver round right now? That gap, called the retail premium, is already widening at dealers across our country as the logistics blackout filters through the supply chain. This is not speculation. This is the market's early warning system firing off signals that the headline number hasn't caught up to yet. And the Dubai disruption didn't land on a healthy, fully stocked market. It landed on a market that was already dangerously thin. According to COMEX data, registered silver inventory, The metal that is actually sitting in exchange-approved vaults and available for physical delivery has already fallen 31% since late 2025. That decline was happening before a single missile fired. Asia had been steadily pulling physical metal out of the Western system for months, and the vaults were quietly bleeding inventory with almost no mainstream financial coverage of the trend. Think about what that means structurally. The pool of silver backing the paper contracts that millions of American investors hold was already shrinking before this crisis began. Dubai's shutdown didn't create the vulnerability. It exposed one that was already built into the system, layer by layer, shipment by shipment, over the past several months. Here's what should grab our attention most right now. The physical market and the paper market are increasingly operating as two separate realities. In Dubai, physical gold premiums have been running near 40% above COMEX paper prices. 40%. That means buyers in the physical market, the market where actual metal changes hands, are paying nearly half again the price that your financial app shows you. When you see that kind of divergence between what paper says and what physical buyers are actually paying, you're watching the early stages of a breakdown in price discovery itself. Have you noticed something interesting about every major commodities shock in recent American history? The warning signs were always there in the physical market weeks or months before the paper price moved. Oil in 2022, natural gas in Europe, agricultural commodities during supply chain disruptions. The paper markets, driven by financial algorithms and futures contracts, are extraordinarily good at maintaining a fiction of stability right up until they can't anymore. Then they reprice. Fast, hard, and without mercy for anyone who wasn't paying attention. Silver at $83 is the paper market's current story. But the physical market, the one where refiners, industrial buyers, jewelry manufacturers, and serious investors actually exchange metal for money, is telling a very different story in Dubai, in Shanghai, in Mumbai, and increasingly at dealers right here in the United States. What we're watching unfold this week is not just a Middle Eastern logistics problem. It is the collision of a supply chain disruption with a market that was already running on fumes. And the 48-hour window that traders are watching most closely, the window between now and when these dynamics force the paper price to catch up with physical reality, may be the most consequential period for silver investors in years. In the next part of this story, we're going to look at the hard data underneath all of this, the COMEX numbers that tell you exactly how thin this buffer really is, the Shanghai evidence that proves Asia isn't buying through the system anymore, it's bypassing it entirely. And the mechanism by which a vault drain that started months ago has now left Western investors holding paper, while the physical metal quietly moved east. The Dubai air bridge just went dark, the vaults were already emptying, and the paper price hasn't gotten the memo yet. So let's talk about what the data actually shows, because this isn't a theory and it isn't a gut feeling. There are three distinct layers of hard evidence sitting in plain sight right now. In COMEX filings, in Shanghai exchange reports, and in the premium spreads that professional traders watch like a vital sign monitor. Each layer tells part of the story. Together, they paint a picture that should make every American with savings tied to precious metals stop and take a very serious look at what they actually own. Start with the COMEX. On February 27th, 2026, just days before the Dubai shutdown, delivery notices were issued for 10,526 contracts on silver. Each contract represents 5,000 ounces. Do the math, and that's 52.6 million ounces of silver demanded for physical delivery in a single day. Now here's the number that matters most. Total registered silver inventory in COMEX-approved vaults at that moment sat at roughly 86 million ounces. That means in one trading session, buyers demanded delivery of 60% of the entire deliverable supply that the exchange had available, 60% in one day. To put that in terms that hit closer to home, imagine your bank had $86,000 in its vault to cover all its depositors, and in a single morning, customers showed up requesting $52,000 in cash withdrawals. The bank would still be technically solvent for about another afternoon. That's the buffer COMEX is operating on right now, and it was already that thin before Dubai's cargo flights went dark. According to exchange data, registered inventory has fallen 31% since late 2025, and the trajectory was pointing straight down long before any missile fired in the Gulf. This is what traders mean when they talk about the critical red zone, the threshold below 80 million ounces of registered silver, where the exchange's ability to honor physical delivery demands becomes genuinely uncertain. We are not far from that line. And every day that the Dubai air bridge stays paralyzed, the path to that threshold gets shorter. But here's where it gets interesting, and honestly, a little alarming, because the COMEX data is only the first layer. The second layer is what Asia was already doing before this week's crisis ever started. Because the Dubai shutdown didn't trigger Asia's appetite for physical silver, it just removed the last speed bump that was slowing it down. For months, quietly, methodically, and almost entirely beneath the radar of mainstream American financial media, Asian buyers have been pulling physical silver out of the Western system at a pace that has no modern precedent. Shanghai Vault silver inventory collapsed 43% between November 2025 and February 2026. Nearly half of China's locally held silver reserves gone in roughly 90 days. That's not traders rotating positions. That's not seasonal demand. That is a structural drain. Institutions and sovereign-level buyers converting paper claims into physical possession at a scale that suggests they know something about the future of this market that most Western retail investors do not. And here's the critical detail that changes the entire picture. Asia didn't just draw down its own local reserves and stop there. It exhausted them. Shanghai's vaults are now running so thin that Chinese buyers are competing directly with American buyers and European institutions for the same shrinking pool of COMEX registered silver. The same 86 million ounces that was already absorbing 60% delivery demands in a single session is now the target for Eastern demand that has nowhere else to go because their own local supply ran out months ago. What does that mean for you? It means the story you've been told about gold and silver markets, that there's a deep, liquid, global pool of metal available to back every paper contract ever written, is quietly becoming fiction. The pool isn't deep anymore, it's shallow, it's shrinking. Now the pipe that was refilling it from the Middle East has been shut off. Now, let's talk about the smoking gun. Because if you want proof that the physical market and the paper market are already operating as two separate financial realities, you don't have to take anyone's word for it. You just have to look at the premiums. In Shanghai right now, physical silver is trading at a 12 to 13% premium above the COMEX paper price. That means if COMEX says silver is worth $83 an ounce, buyers in Shanghai's physical market are paying roughly $93 to $90 to actually get their hands on real metal. But that's not even the most extreme data point. In Dubai, the same city whose airport just went dark, physical gold premiums have been running near 40% above COMEX paper prices, 40% above the number your financial app shows you. What if I told you that gap isn't a pricing error? It isn't market inefficiency waiting to be arbitraged away. It is the market itself telling you, loudly, in dollar terms, that the paper price has lost touch with physical reality. When a buyer in the physical market has to pay 40% more than what the exchange says the metal is worth, it means one thing. The exchange price is wrong. Not wrong by a little. Wrong by a number that, if it closes, will represent one of the most violent repricing events in the history of modern commodities markets. Here's a scenario to make this concrete. Imagine you're a manufacturer in Shenzhen who needs physical silver for electronics production next month. You don't care about futures contracts or paper positions. You need actual silver in a vault deliverable to your facility. You look at the COMEX price, $83. You look at what's actually available in the physical market, $90 in Shanghai and climbing. You call your broker in Dubai. Your broker tells you the cargo flights are grounded. What do? You pay whatever it takes, because your production line shuts down without it. That desperation, multiplied across thousands of industrial buyers across Asia, is exactly the force that is pulling physical metal away from Western paper markets right now. This is what the Federal Reserve and mainstream financial commentators mean when they talk about price discovery breaking down, except they rarely explain it in terms that connect to your retirement account or your physical stack sitting in a home safe. Let me do that directly. If you hold a silver ETF, what you own is a paper claim. Your ETF holds contracts. Those contracts are backed by registered inventory at COMEX. That inventory just had 60% of it demanded in a single session, and the supply chain that was supposed to replenish it is paralyzed in the Persian Gulf. The chain of custody between your paper claim and actual physical metal has never been longer or more fragile than it is right now. The Shanghai premium is not a curiosity. It is the market's real-time verdict on what physical silver is actually worth versus what the paper market is still pretending it's worth. And the spread between those two numbers, 12% in Shanghai, 40% in Dubai, is the gap that eventually closes. History tells us clearly how that closing happens. It doesn't happen by physical prices falling back to paper levels. It happens by paper prices racing violently upward to meet physical reality. Think about the last time you saw a commodity market where physical supply was genuinely constrained while paper prices sat artificially calm. The natural gas crisis, lumber in 2021, shipping containers in 2020. In every single case, the paper market held its fiction for weeks, sometimes months, and then repriced in days, not gradually, not with warning. In days. Silver's registered COMEX inventory was already down 31% before Dubai went dark. Asia had already drained its own local reserves and was already competing for the same Western supply pool. And now the 20% of global metal flow that moved through Dubai's air corridors is frozen, with no realistic overland rerouting option and no timeline for restoration. The supply starvation mechanism is not building toward a crisis. It is a crisis. The paper price just hasn't been informed yet. But the physical market, the one where real metal actually changes hands between real buyers and sellers, is already living in a different price reality than anything your brokerage account is currently showing you. 3 layers of proof. COMEX inventory at historic lows. Asia's vault drain already exhausted and now pointed directly at Western supply. Shanghai and Dubai premiums, screaming that paper and physical have separated. Each one on its own would be a story worth paying attention to. All 3 together, combined with a paralyzed Dubai air bridge and a weekend ahead with no resolution in sight, that's not a story. That's a sequence with a predictable ending. And in the final part of this, we're going to walk through exactly what that ending looks like, what the math says about price targets and timing, and most importantly, what every American investor over 40 should be doing right now before this moves from a warning into a reality. Let's connect every dot we've laid out and talk about what the math actually says. Because at some point, supply gaps stop being abstract and start having very specific price consequences. That moment may be closer than almost anyone in mainstream financial media is currently willing to say out loud. Start with gold, because gold tells the story in the most visible terms. On January 29th, 2026, gold hit an all-time high of $5,594 per ounce. That record was set against a backdrop of mounting geopolitical tension, central bank accumulation, and early signs of the very supply chain stress we're now watching accelerate in real time. Then the market pulled back, as markets always do after a vertical run, and the paper price settled into what looked like a consolidation range. Calm, orderly, controlled. But here's what changed this week. The Dubai shutdown didn't just disrupt logistics. It removed the physical supply ceiling that was keeping a natural lid on how fast prices could move. When metal can flow freely, from refiners through Dubai to vaults in New York and London, arbitrageurs can keep paper and physical prices reasonably aligned. That mechanism is now broken. The path back to gold's January record, and potentially well beyond it, has reopened in a way it hasn't since that all-time high was set. And unlike January, the supply chain that would normally absorb a price spike by routing more metal into Western vaults is currently grounded at an airport in the Persian Gulf with no restart timeline. Silver's math is even more stark. At $83 on paper, silver looks like it's resting. But what we've established across the last 2 chapters is that the paper price is increasingly disconnected from what's happening in the physical world. Here is the scenario that serious traders are now openly discussing. The moment COMEX registered inventory crosses below that 80 million ounce red zone threshold, which the current trajectory makes entirely plausible within weeks, not months, physical silver stops being available at anything close to the screen price. Not because the paper market immediately crashes, but because dealers, refiners, and industrial buyers stop accepting paper price offers for metal they can sell into a physical market paying 30, 40, or 50% more. When that moment arrives, the spot price becomes largely irrelevant for anyone who actually needs physical silver. You can watch $83 on your screen all day long, but if every dealer with inventory is charging $110, $115, or $120 for an actual 1 ounce round, because that's what the real market is clearing at, then the number on your app is a relic, a ghost price from a system that no longer reflects reality. And the people who get hurt worst in that scenario are the ones who waited for the screen price to confirm what the physical market was already screaming. Now, let's talk about the most urgent near-term risk, because this is the one that has traders genuinely on edge heading into this weekend. The Strait of Hormuz. That waterway controls roughly 20% of global oil flow, and an even higher share of Gulf air logistics infrastructure, the same infrastructure that Dubai's cargo network depends on. Any further military escalation in or around the strait over the coming days, any expansion of the conflict that prompted the March 1st strikes, creates a scenario where silver could gap past $95 per ounce before the next trading session opens on Monday morning. Think about what a Monday gap actually means for your portfolio. The futures market is closed over the weekend. Your brokerage app shows you a price from Friday's close. You wake up Monday morning and the market opens $12 higher than where you last saw it. If you were waiting for a better entry point, waiting for a dip to buy physical metal or add to a position, that entry point is now gone, permanently, before you had a single chance to act on it. This is not a hypothetical. Monday gaps after weekend. Geopolitical shocks are one of the most well-documented phenomena in commodities trading. And right now we are sitting at the intersection of 3 compounding factors: a paralyzed supply chain, historically thin COMEX inventory, and an active military conflict with no weekend ceasefire in sight. That make this one of the highest risk weekend setups for silver investors since January's all-time high. So what do you actually do with all of this? Because information without action is just anxiety, and that's not what this conversation is for. Let's get specific. The first thing every American investor, especially anyone over 40 with meaningful savings in precious metals, needs to do right now is answer one honest question. Do you actually own physical metal, or do you own a paper claim on metal? That distinction has never mattered more than it does this week. A paper silver ETF, a futures contract, an unallocated storage account at a bullion bank, all of these are promises. They are promises backed by chains of custody that run through COMEX registered vaults, through custodians, through the very supply networks that are currently under maximum stress. When the system works perfectly, those promises are fine. When the system is operating with 60% of deliverable inventory demanded in a single session in a paralyzed Middle Eastern supply corridor, those promises are only as good as the weakest link holding them together. Allocated storage is different. Allocated means specific numbered bars or coins held in your name at a specific vault, legally segregated from the custodian's own assets. If that institution fails, your metal is yours. It is not part of the bankruptcy estate. Unallocated storage means the institution owes you metal, but the specific metal sitting in any given vault may or may not be yours in any legally meaningful sense. In normal markets, unallocated is convenient and cheap. In a supply crunch, it is the last category of claim you want to be holding. Physical possession is the most direct form of ownership, and for Americans holding silver specifically, the window to acquire physical metal at anything close to current paper prices may be narrowing faster than the screen price suggests. Retail premiums, the markup above spot that dealers charge for physical coins and rounds, are already climbing at distributors across our country. This is not fear-mongering. It is the normal market response to a supply chain disruption filtering through the wholesale tier toward the retail tier. The sequence always runs wholesale first, retail second, and paper price last. We are currently in the transition between wholesale and retail. The paper price is still catching up. Here is the simplest checklist that cuts through all the noise. First, know what you own. Pull up your account statements right now and identify specifically whether your precious metals exposure is physical possession, allocated storage, unallocated storage, or a paper ETF. Each category carries a different risk profile in the environment we are describing. Second, if you hold unallocated storage or paper ETFs and you've been considering converting to physical or allocated, the premium clock is running. Every week, the Dubai shutdown continues. Every delivery demand that draws down COMEX registered inventory further makes that conversion more expensive. Third, if you're considering new physical purchases, the question to ask your dealer is not what's the spot price today, but what's your current premium and what's your delivery timeline. A premium that's jumped from 3% to 8% in a week is the market telling you something the paper price hasn't said yet. And here's the final, honest framing for everything we've covered today. The Dubai air bridge collapse did not create this crisis. It exposed one. The COMEX inventory drain was already happening. Asia's vault exhaustion was already happening. The Shanghai and Dubai premiums were already diverging from paper prices. The system was already running thinner than at any point in recent memory. What March 1st did was remove the one remaining mechanism, the physical flow through Dubai's cargo network, that was keeping the paper and physical markets tethered to the same price reality. We are not predicting a collapse. We are not calling for panic. What we are doing is reading the same data that institutional traders, sovereign wealth funds, and central bank buyers are reading right now, and translating it into plain language for the everyday American investor who deserves to understand what is actually happening in the markets that affect their savings, their retirement, and their financial security. Gold set its all-time high on January 29th. Silver is sitting at $83 on paper, while the physical market is pricing it dramatically higher in every major trading hub on Earth. The vault that was supposed to keep replenishing Western supply is grounded. The inventory buffer that was supposed to absorb delivery demand is at historic lows. And a weekend of continued geopolitical uncertainty sits between us and Monday's open. You now know what the mainstream financial press isn't connecting for you. What you do with that knowledge is entirely up to you. But the window to act on it before the paper price catches up to physical reality has never been shorter than it is right now.